David R. Guttery is the president of Keystone Financial Services in Trussville, Alabama. David Guttery is a financial advisor who represents Emeritus Investment Company, LLC, and Emeritus Advisory Services. Please stay tuned through the end of the video for additional important disclosure information.
Hello everyone, I'm joined by David Guttery today, president of Keystone Financial Group here in Trussville, for his thoughts about strategies for investing through a recession. David, thanks so much as always for joining us. You know, a few weeks ago in part one of this series, you offered your thoughts on whether or not we are in a recession. So today, I want to ask an obvious follow-up question. If we are in a recession, and will likely be in one for a while, then what strategies should our viewers consider for investing through such periods of time?
Absolutely. First, let me just say that every wealth management plan is implemented with guardrails that are unique to the client. These guardrails address limits and tolerances for risk, and they codify such things as objectives and the time with which that we have to achieve those objectives. There is no uniform one-size-fits-all answer to your question. Whether we are in a recession or not, one universal truth still holds, and that is investment portfolios that are used to implement holistic wealth management plans should be individualized and reflect the unique characteristics of the client. So these thoughts are at a very high level. We have drawn reference to this graphic within previous videos. It is the economic cycle. I've encouraged people to think of it in terms of changing seasons. Imagine how your behavior is incentivized by what you feel. As we move from the left to the right on this chart and the seasons change from spring to summer to fall to winter and then back to spring, think about how that incentivizes your choice of clothing. During the summer, you're wearing short-sleeve shirts. During the winter, you're wearing jackets. Clearly, as evidenced by economic metrics to which we drew reference within our last video, we are in the winter season of this cycle. Therefore, the jackets that we are wearing consist of consumer staples, utilities, healthcare, mega-cap pharmaceuticals, and energy. These are all durable areas of the economy. You will consume these products and services durably, regardless of the economic state within which we find ourselves. Portfolios change from season to season, but what should be in your portfolio now should reflect the season that we are in. I first saw this graphic 35 years ago when I was in school, and to my recollection, it has never been wrong. The key is understanding where we are in the economic cycle for this to be of benefit. Now, having said that, I would also suggest that there is a deeper analysis to be made. At the present time, I would suggest there is an equities part of the conversation, a fixed income part of this conversation, and there's an alternatives part of this conversation. With the oddities that we have observed and the discussion within our last video, you really do need to think outside of the box because historical anecdotes are of very little value right now.
Now that is a great high-level overview. So let's take these one at a time. You mentioned there being an equities part to these considerations. Can you elaborate on that?
Sure. This is what I call Warren Buffett thinking. Stop for a moment and consider some very obvious things that are right in front of you. Who is the manufacturer of your razor blades? What company makes your toothpaste? Who makes your favorite bar of soap, dishwashing detergent, and favorite beverage? Who are the companies that make the things that you purchase consistently? Of all of the things that you consume in a given month, which are the ones that you can't do without? These are what I call economically durable products and services. So as I mentioned in our previous video, evidence suggests that 66% of American households are living paycheck to paycheck, and the personal savings rate is at a low level not seen since August of 2009. In that environment, I would suggest that discretionary things that you don't necessarily need will be the first things to be pared away from monthly consumerism. Therefore, we can expect the revenues and the earnings of such companies to likely be lower during recessed periods of time, so avoid these companies. Rather, focus on the companies that produce the things and the services that you will consume durably. Next, we must evaluate the companies in terms of financial health and strength. which companies are trading at a low and attractive forward PE ratio, which companies are paying a higher and attractive dividend. It isn't enough to identify the manufacturers of durable products and services, but you must further screen those companies for health and positioning within their relative groups of peers. This helps to build what I call the dividend put. Put, being a metaphor, simply suggests that if I can build a larger and steady stream of dividend income into the portfolio, the more insulated that portfolio will become from day-to-day volatility. At a very high level, I have encouraged clients to think of it this way. If your overall return reflects a loss of 10%, but the things that you own are returning a 5% dividend yield over the coming 12 months, then in my mind, you're down net 5%. The construction of the dividend put is a very real way to offset the volatility of a recessed period of time. Those dividends can be constructed by using the stocks of companies that produce the things that you are consuming durably. Those products and services will be among the last things to be pared away from a budget during a recessed period of time. I would also draw reference to the part of my previous video within which we discussed observable actions by corporations today. Metrics regarding labor costs and worker productivity are very caustic right now. There is ample evidence that corporations are trying to become leaner in this environment, not bigger. The most recent reading on second quarter annualized labor costs showed an increase of 10.8%, while worker productivity declined by 4.6%. We saw similar metrics in the first quarter as well. So what observable evidence do we have that corporations are attempting to become leaner in this environment? We have heard from process automation technology companies as well as information management companies that revenues are being driven by enterprise-level pricing as companies attempt to streamline their automated industrial processes and the efficiency with which data is managed in an effort to employ fewer people remotely and to replace the human element with automated processes. So, from a strategic hold standpoint, it would make sense to have a narrowly focused holdings in such equities while also maintaining large, nebulous footprints in the staples, utilities, pharmaceuticals, and other such companies that I mentioned earlier.
Well, thank you, David. That makes a lot of sense. Well, you mentioned a second consideration of portfolio construction that involves fixed income. Why is this also an important part of a portfolio when navigating a recession?
I believe that every portfolio, regardless of the objective and time, should have a component of fixed interest. Normally, this provides negative correlation against volatility and buoyancy through the inclusion of bond yield into the portfolio. As we discussed in our last video, however, this is a very strange period of time. Treasuries and equities are positively correlated for the first time since 1972. I was 3. Clearly, that was a long time ago. Being positively correlated means they are moving in the same direction. You are looking at a graphic that I obtained from Bloomberg that indicates the degree by which the 2 versus the 10-year Treasury yield curve is inverted. It is more inverted than at any other point we have observed since the year 2000. An inverted yield curve simply means that you have prices that are going down as evidenced by rising yields. There are a myriad of reasons for this, but at a very high level, it mainly comes down to there being a glut of U.S. Treasury debt on the open global market. Again, we discussed this in greater detail within our last video. For today's discussion, it is an important observation because we are not able to achieve negative correlation with market volatility by owning Treasury securities, for example, that have historically given buoyancy to portfolios during times such as these. So what do we do about it? At this time, we are focusing heavily on fixed income investments that are issued by the same corporations that I mentioned in the equities part of the discussion. The health of these companies is critical, though, when you're considering their fixed income issues. Furthermore, we seek to hold maturities of less than 5 years with single or double A credit quality or better in an effort to minimize duration and maximize the yield into the portfolio. And this does not guarantee against negative price movement, but so far this year, it has certainly been less pronounced than what we have seen from the Treasury complex.
Well, great information. I believe you referenced the third component of portfolio construction as being alternative investments. Can you elaborate on exactly what those are and why they might fit in an environment like this?
Absolutely. Alternative, as the name implies, means something outside of the normal and customary box of standard investment tools. These can be real estate investment trusts, unit investment trusts, limited partnerships, and they can also include things such as structured notes and market-linked CDs. Very often these alternative investments are limited to accredited investors because of their complexity. However, in certain situations they can be very useful tools for achieving the negative correlation and the income for which we're seeking at this time. Having said that, I would also suggest that there are some very obvious tools that I would include in this category, but that are often overlooked, but could nonetheless be very useful. For example, the products of insurance companies, including but not limited to equity indexed annuities and cash value building life insurance. These can be viewed as external complements to what we maintain as a sleeve of fixed income securities in a brokerage account. With universal life, for example, we have attributes including the guarantee of principal, the tax-sheltered aspects of life insurance, and a fixed interest rate that is often higher than what you can find with traditional fixed income products, and on par with the yield that could otherwise be generated from a sleeve of bond investments. So again, you really have to think outside of the box in an environment like this. The yield curve is more steeply inverted than at any other point in the last 20 years. The dollar is on the verge of setting a new all-time record high against the global basket of currencies. Treasuries are positively correlated with equities for the first time in 50 years. The University of Michigan Consumer Sentiment Survey is at an all-time record low. The Goldman Sachs Housing Affordability Index is at a level that we haven't seen since the early 90s. And as we mentioned within our previous video, because of the strength in the dollar, gold is also positively correlated with inflation. So I would strongly encourage your viewers to work diligently with their source of holistic wealth management to think outside of the box for solutions to meet such a strange period of time. In closing, let me just draw one last reference to the economic cycle chart that we viewed at the beginning of this video. In terms of the clothes that you wear during changing seasons, there is always something to wear. In some cases, the choice of those articles is pretty obvious. But in a difficult time like this, you really have to think outside of the box for creative ways to find warmth during a cold, recessed period of time.
Well, David, as always, thanks so much for this really helpful information. And for additional information, David may be reached through the means listed upon the following screen. For the Trustful Tribune, I'm Brannon Dawkins.
David Guttery independently offers securities and investment advisory services through Ameritas Investment Company, LLC, member FINRA, SIPC, and Ameritas Advisory Services. Information provided in today's segment is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed and should not be interpreted as tax or legal advice. Any performance stated is past performance and is not indicative of future results.